Welcome to the first chapter of this course on residential financing, a cornerstone of every real estate transaction. As a licensed Arizona real estate professional, your ability to speak confidently and knowledgeably about financing options can directly impact the success of your client's home purchase. From conventional loans to government-backed programs, buyers rely on agents to help them navigate loan options that shape their monthly payments, qualification paths, and long-term financial obligations. But with that responsibility comes the duty to stay within the bounds of ethical and legal conduct. Arizona law and federal regulations have clear standards for what real estate licensees can say and do when it comes to lending discussions. For instance, ARS. Paragraph 6-909 regulates mortgage bankers and brokers operating in Arizona, ensuring that consumers are protected through oversight of who can originate or broker loans. AAC R428-1101A demands that licensees conduct their business with fairness, honesty, and by disclosing all material facts. RESPA and TILA require that lenders issue important disclosures like the loan estimate and closing disclosure to help consumers make informed borrowing decisions. Fair lending principles are enforced under the Equal Credit Opportunity Act, EQOA, and fair housing laws, which prohibit discrimination in any part of the lending process. This chapter is designed to help you understand major loan types and how they relate to your client's financial journeys. While you are not expected to be a lender, you are expected to be a trusted guide, knowing the basics and knowing when to recommend a lending professional. Let's begin. Section 1. Major loan types in the residential market. When guiding buyers through the home purchasing process, it is essential that real estate professionals understand the different loan options available and how these loans impact a buyer's financial responsibility. This section breaks down the key residential loan types that Arizona buyers are most likely to encounter. Conventional loans. Conventional loans are mortgages that are not insured or guaranteed by any government agency. These are often referred to as conforming loans if they meet the loan limits and underwriting criteria set by Fannie Mae or Freddie Mac, the two government-sponsored enterprises, GSEs, that buy and securitize these loans on the secondary market. Key characteristics. Typically require higher credit scores, often 620 and above. Buyers usually need a larger down payment, often 5% to 20%. If the buyer puts down less than 20%, lenders typically require private mortgage insurance, PMI, to protect against default. Example: a buyer with a credit score of 740 and 15% down payment secures a 30-year fixed-rate conventional loan. Because the down payment is under 20%, the lender adds PMI until the borrower reaches 20% equity. FHA loans, Federal Housing Administration. FHA loans are insured by the Federal Housing Administration, making them a safer bet for lenders when working with borrowers who may not meet conventional lending standards. Key characteristics. Minimum down payment as low as 3.5%. Lower credit score thresholds, as low as 580 with 3.5% down. Requires mortgage insurance premiums, MIP, for the life of the loan in many cases. Ideal for first-time homebuyers or buyers with limited savings. Example: a first-time buyer with a credit score of 610 uses an FHA loan to buy a $250,000 home, putting down just 3.5%, $8,750. Although mortgage insurance is required, the low entry cost helps them buy now instead of waiting years to save a larger down payment. VA loans, Veterans Affairs. VA loans are guaranteed by the U.S. Department of Veterans Affairs and are designed to help service members, veterans, and qualifying surviving spouses become homeowners. Key characteristics. No down payment required. No PMI required, even with no money down. Must meet eligibility criteria, verified through a Certificate of Eligibility, or COE. Generally have competitive interest rates. Example: an active duty service member qualifies for a VA loan on a $300,000 home, With no down payment and no PMI, they save significantly on monthly costs compared to other loan types. USDA loans, United States Department of Agriculture. USDA loans support home ownership in rural and certain suburban areas, with a focus on low to moderate income borrowers. Key characteristics: no down payment required. Property must be in a USDA eligible area. Income limits apply based on location and household size. Must be used for a primary residence. Example: a family with a modest income finds a home in a USDA eligible area outside Tucson. With no down payment and affordable fixed interest, they purchase the home with less cash out of pocket. Other loan types: jumbo loans, used for homes that exceed the conforming loan limits set by Fannie Mae and Freddie Mac. Often used in high-cost markets or for luxury properties. Stricter qualifications and larger down payments required. Adjustable rate mortgages, ARMs. Start with a lower interest rate for a fixed period, e.g., 5 years, then adjust annually. Suitable for buyers who plan to sell or refinance before rate adjustments. Fixed rate mortgages. Maintain the same interest rate for the entire loan term, e.g., 15, 20, 30 years. Offer predictable payments. The role of the lender in the home buying process. Lenders play a pivotal role in determining a buyer's purchasing power, guiding them through qualification, approval, and final loan processing. Their responsibilities involve detailed assessments, regulatory compliance, and consumer transparency. 1. Pre-approval and qualification. Pre-qualification is a preliminary estimate of what a buyer might afford based on basic financial information. Pre-approval is a more detailed process involving credit checks and verification of income, debt, and employment, resulting in a conditional commitment from a lender. Loan origination and underwriting. The origination phase involves collecting documentation such as W-2s, bank statements, tax returns, and employment verifications. Underwriting assesses the risk of lending to the buyer. Underwriters verify financial information and ensure the loan meets program guidelines. Issuing loan estimate and closing disclosure. Under RESPA and TILA, lenders must issue a loan estimate within 3 business days of application, detailing estimated interest rates, monthly payments, and closing costs. A closing disclosure must be provided at least 3 business days before closing, giving buyers final figures. Compliance and risk management. Lenders must comply with federal laws like RESPI, TILA, and ECOA, as well as Arizona lending statutes, ARS, paragraph 6909. Risk management includes ordering appraisals, verifying employment, checking credit, and ensuring documentation supports the buyer's ability to repay. Real estate licensees should understand these lender responsibilities to set accurate expectations for their clients and stay within the scope of lawful and ethical real estate practice as required under AAC R428-1101A. Legal and regulatory considerations for Arizona licensees. Real estate professionals must be aware of relevant laws when discussing financing options with clients. ARS, paragraph 6909, governs the licensing and regulation of mortgage bankers and brokers in Arizona. AAC, R428-1101A, requires real estate licensees to deal fairly, honestly, and disclose all material facts to all parties in a transaction. RESPIA and TILA, federal regulations that require lenders to provide standardized disclosures, including the loan estimate and closing disclosure. ECOA and fair housing. Lenders and licensees must avoid discriminatory lending practices under the Equal Credit Opportunity Act and Arizona fair housing laws. Understanding these loan types and the legal framework surrounding them allows real estate professionals to better serve their clients, make accurate referrals to lending partners, and avoid legal pitfalls. Licensees should always defer to mortgage professionals for in-depth financing advice while staying compliant with disclosure and ethical standards.